Dr. J, I mean, this idea of tradable bottom, short-term bottom, not the bottom, I think that's the kind of thing that Mark Newton's talking about from Fundstrat, where he says breakouts above SPX 4114 and the Qs at 306 are minimum requirements for what's needed to think the lows are in. He thinks the trading lows are certainly close. These are his words. However, a move back to new lows is still needed to satisfy many of my technical concerns. I mean, that's what you continue to hear, because the people who have seen markets over the decades, like you have, Doc, say we just haven't had that classic sign of panic, capitulation, VIX rips through the roof, everybody gets crazy scared, and then you can declare, okay, maybe the bottom is in. Irrespective of that, last Friday we had expiration, and we've had a nice move since. Now, it's kind of deja vu because the last time, 2 weeks ago, we had a nice move since, we gave it all back. Do you have any indication that we're not going to give it all back, let's say next week?
Well, the best sign of that, Scott, is that you and I have talked a lot about that volume and volatility. The volume definitely showed up on that huge sell-off this week when we saw 52 million options print. That was a good sign because that was, I think we said, 24% above the average for the year. So that's a positive sign, Scott. It didn't occur at the same time as the VIX spike. And normally we would like to see something like that, even though, as Jim said, it's painful to see that, whether it's somebody getting laid off or whether it's a spike in the VIX and a spike in volume. You'd sort of like to see those pretty close together, and they haven't been so far. But to the comments about the Fed, that University of Michigan survey today, Scott, that came out saying that a majority of their polling audience believes that 5 and 10 years out, we're still going to be looking at a 3% inflation rate, which is 50% above, of course, what the Fed more or less has set on their own as their mandate, 2%. If the Fed softens up and moves a little bit more towards that, then I think instead of just soft-ish, we could see that soft landing. We're all worried that the Fed's going to hit it too hard and that chemotherapy that they hit it with kills the patient. Hopefully something like this, saying Americans are more comfortable with seeing a 3% inflation all the way out 5 and 10 years, that's a positive sign, Scott, and maybe that's why we could be a lot closer to that bounce that we've all been looking for.
So Richie Saps, my guy's been negative too. You have more cash. You've raised more cash maybe that you've ever had. And I see that you have sold Disney. You sold NextEra Energy. Now, you did buy some energy names, which isn't a big shock to me. You trimmed Boeing, trimmed Cisco, trimmed Raytheon, trimmed Walmart. Are you still as negative as you've been?
Yeah, Scott, it's ironic that no one's really talking about the big fish in the room. That's quantitative tightening. We think about the Fed added $4.5 trillion to its balance sheet in 2 years. That's 20% of GDP. Took it up to $9 trillion. It inflated all kinds of asset values, real estate, stocks. Think about Jack Dorsey's tweet that went for $2.9 million, and now the bid is, what, around $15,000. And now we're going to start seeing a reverse of that liquidity. Okay, on top of that, we have the war-induced inflation. Then we go to recession concerns. We have weakening ISM, depressed consumer confidence, and the money supply now is growing at only 1.5%, the M2. So the way we look at it is
M2 is shrinking.
What? That's shrinking.
Money supply is shrinking.
Yeah, the M2. But our concern here is that when you couple all of these uncertainties, it's leading to a fog in where earnings are going to be. So our view is, sure, we can get a tradable bottom, but in the long run, we want to wait for some of these uncertainties and more clarity in the earnings to reset. And that's why we've got a high cash position right now. We're comfortable with it, and I'd rather wait till there's more clarity. Okay. And even if the market's up 10% before we add.
So we have what feels to me then, folks, to be two categories of investors here. And that's the kind of conversation that we're having. We're talking about the same issues, but we are approaching them from two different places. There are some, it sounds to me, on this panel who are willing to engage in a potential short-term bottom, whereas it sounds to me, Steve, like Rich, for example, is like, I don't want any part of that because my longer term is worrisome. I'd rather raise the cash and sit out of the tradable near-term bottom because I don't like what's coming down the pike. You were in that place, but now it feels like you're ready to engage as well because you don't want to miss out on what could be another leg to this. I'll call it bear market bounce. I mean, whatever you want to call it, we can call it what everybody else is calling it. Is that fair?
I'm going to be short term because Rich hit it absolutely dead on. You've got QT coming, and that's going to keep going. And by the way, Bostic isn't a voting member, so let's take what he says with a grain of salt. So that's why I'm more worried, because the market is now discounting sort of the end of the tightening cycle, whereas I believe it's just begun, and the Fed is not going to go back and forth a million times. So we're going to get two tightenings in June and July, 50 basis points each. Powell was clear, and QT is starting at the same time. And you're seeing margin pressures. And these companies, particularly the retailers that have come out with the pie in the sky guidance going forward, they're going to be dead wrong because gas prices keep going up. So while some inflation inputs have come down, overall, it's not meaningful. So this is a very, very short-term position for me, as I've made clear, and that's why I said I'm more negative than I was before.